The Money Café is proudly brought to you by Intelligent Investor, Australia's home of value investing. For a limited time, you can get Alan Kohler's weekend brief, in-depth economic analysis, CEO interviews, the latest market insights, a limited edition Money Café cap and more for just $297. Find out more at moneycafe.com.au.
Hello, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and finance presenter and columnist and podcaster for the ABC.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. And James, you're in Perth. Why are you there?
I'm in Perth, yes. We have our mining summit here today on Wednesday. And it's always a great event. Great to get over to Perth. We went up to the Pilbara on Monday and had a look at one of Rio Tinto's mines called Western Ranges, and I hadn't been up there before, so it was quite an experience. You know, you sort of write about the Pilbara and mining for 25 years, but to finally get there and have a look and see just the scale of just one mine was quite eye-opening.
I flew over the Pilbara once, I think in 1975, with Lang Hancock driving the plane. It was a small plane, and Lang Hancock was driving, and he was showing me his, whatever he had up there, and we're up high at one point, and he says, "Have a look at this," and he dives down, did a massive dive, and I thought I was going to die. Anyway,
well, we had no such acrobatics. Even that is a really good point, Alan. Like the you're flying full Qantas jets up to these tiny towns, such as the sort of infrastructure and the logistics of the FIFO system, and it's amazing.
Yeah.
Yeah, very interesting.
Very good. Okay, so Iran, what do we think? They haven't got a deal yet. They've been talking it up Trump's been talking it up for a few days, and then he starts blowing up their ships in the Strait of Hormuz, and that's going to, and then Iran's got upset about that, so that's going to hold up a deal between the two, isn't it?
Yeah, you'd think so. I mean, the issue here, I think, is that Donald Trump sort of created a bit of a monster in a way. Obviously, the Iranian regime was monstrous before, but now they're monstrous and switched on to the leverage that they've got over the world. This is what everybody says, is that no geopolitical expert ever thought that the Strait of Hormuz would ever be shut. And yet here we are. The Strait of Hormuz is shut, and it's been shut for the best part of 10 weeks. The Iranians have got a pretty strong hand. They've got no great incentive to open the strait quickly without securing a good deal for themselves. So, and Trump seems to have this view that he holds all the cards, and it doesn't seem to be any great hurry in his mind. So it's very strange. I mean, the market keeps telling us that the logical conclusion here is a deal, and a deal pretty quickly, because the market's looking at, the gasoline price, which is now creeping. Well, it's well over $4, and starting to creep towards $5 in some for diesel and in some places. And they're also looking at Trump's approval ratings, which they're not in the toilet; they're in the S-bend. and you would think that Trump's really he's famously attuned to what voters want. This time he just seems to be brazening it out. So as the midterm elections in November get closer, you just wonder what the strategy is here. That I don't know if you saw, Alan, the consumer confidence figures in America. The stock market's at all-time highs, and consumer confidence hasn't been this low since 1947.
Yeah, that's right. So, I mean, it's a really amazing situation, and Trump does seem to be in a real pickle, because Iran, he's managed to change the regime in Iran as promised, but instead of the Ayatollah Khamenei, who was relatively moderate, he's got this Revolutionary Guard in charge, and they're not moderate at all. And and they, as you say, understand the leverage I've got over the Strait of Hormuz, which in some ways, I mean, what they were trying to get was leverage through having a nuclear weapon, because, you know, everyone who's got a bomb, everyone, you know, other countries are very careful about, which is why they want it. But now they've got the leverage over the Strait of Hormuz, which is, you know, pretty strong leverage as well. And, you know, maybe that's enough. Maybe they'll just give up the nuclear weapons because they've got leverage over the Strait of Hormuz.
Yeah, yeah. I mean, it's been another sort of, I think everything we say about this, Alan, we've got to admit that it's been a pretty humbling episode for commentators and experts in oil and experts in geopolitics. I mean, everybody thought that the sort of by first the end of April, then the end of May, you know, the world would sort of be, I don't know, frozen because of this energy shock. It hasn't turned out to be the case at all. In fact, the sort of global energy complex has adapted really well to this, but it's adapted really well because of two things. A, America's increased its oil exports. And, you know, in some ways you might say, well, they got us into this, so that's the least they can do. And then China's done sort of the right thing by the world by reducing its oil imports and instead drawing on its big stockpiles of gas and energy. So the combination of those two factors has really helped keep, you know, oil and gas flowing around the world and prices, well, much lower than they could have been. But those buffers, you know, they're limited. So Trump needs a deal soon. The world needs a deal soon, or this is going to get even uglier. So let's see where it goes, I guess.
Yeah. And in the meantime, the Australian government is moving on having a domestic gas reservation policy, 20%.
Yeah.
Which obviously the gas companies like Santos are dead against. And where do you think that's going to go? Do you think the gas companies will succeed in their lobbying attempts, or they'll have to put up with it?
No, I'm not sure. I'm not sure they will succeed in their lobbying attempts this time. And my sense from talking to some experts in the industry is that none of the gas people like a reservation policy, but no one in the gas industry likes the current sort of hodgepodge of regulations that they're currently operating in either. So a reservation policy in some ways is unpalatable, but at least it provides a level of certainty. So maybe we do get there in the end. Sure. I mean, no doubt the gas industry will bleat about it. But I think the government is pretty steadfast on this one, and I think they feel, you know, unlike with the CGT changes, that they've got the electorate's backing there. So I think it probably gets through. Definitely lots more bleeding, but I think you picked this up too, Alan. Santos had a big investor day yesterday, and the main purpose of that was to basically tell everybody that, you know, Santos is going to be a brilliant cash machine because they've got their costs down, you know, to basically $50 a barrel, and every $10 above that, they're going to throw off $600 million in cash. So that's their pitch to investors. But I think you saw this too. They had some great charts about the long-term demand for oil and gas, and basically they see shortages in LNG starting to appear in next decade, and oil demand staying basically high and flat until 2050. So it just says to me that, you know, okay, we get through this Strait of Hormuz bit. We should expect pressure from energy, you know, inflationary pressure from higher energy prices. That's going to be a persistent theme for the next, 30 years, I reckon.
Yeah, I think one of the things that came out of the presentation that they made on to the Investor Day was really kind of to remind us that when we're talking about fossil fuels being replaced by renewable energy, that's kind of true, except that within fossil fuels, there isn't one fossil fuel, right? So what's been happening is that gas is replacing coal. It isn't just solar and wind that's replacing coal, it's gas. And so that is a significant underlying demand point for gas, which is going to be maintained, and it can't be really replaced. Not for a long time. So I think that was really interesting. And I, as you say, I put that graph on the ABC News last night showing the shortage of LNG, according to Santos, opening up in 10 years' time, roughly.
Yeah, and even with oil, like their point was, okay, the world moves to electric cars, everyone gets that, but oil for in petrochemicals, which are such a part of everyday life, we haven't really come up with a substitution plan there. Oil for jet fuel, there is no viable alternative at the moment there. Oil in developing countries is still going to, be really important and widely used. So, the energy transition's happening, and when we saw that in Australia this week with the decision on the default energy prices coming down because of take up in solar and batteries, but it's not. It's a transition. It's lumpy. It's bumpy. It doesn't look like a linear out with fossil fuels, in with something else.
No, indeed, that's right. What else is going on? Are they talking in the mining industry in Perth? Are they talking about AI at all?
Oh, I am talking about AI on a panel today, Alan. Indeed. So.
Oh, okay. What's the subject matter of the panel?
It's about AI and tech. And I think when you go up to the mines, you're reminded of how much. Well, they don't call it AI, but it is AI. How much AI is being used already? At Western Ranges Mine, which was opened a couple of years ago, 80% of the trucks in that area, in that sort of mining hub around there, are autonomous. No drivers. 50% of the drills used in that area are autonomous. And so that's a sort of form of AI that's really transforms the way those mines operate. You don't see a whole lot of people on site. And they're mainly, doing supervisory roles, I guess, supervising this autonomous equipment. So, the next jump for them is how do you use more AI? And they are doing that. Like everybody else, there's a whole lot of noise around that, I think. Everyone's got an idea about AI, but how it's practically being used is what I'm hoping to explore on this panel.
The trains are being run out of centres, control centres in Perth, right?
Yeah, that's exactly right. And so
by human beings. By human beings. So maybe they can replace the human beings in those places with AI.
Well, I mean, that is a question that I've got. Like you see on these mine sites, obviously it's, very dangerous work, but all these people flying in and flying out, if you had humanoid robots, you could eliminate that as well. I mean, think of the jet fuel you save. Think of the time you save for people. Think of the safety benefits. Think of the logistics that you don't need. I mean, I don't know how far away that is, but if ever
what sort of things are the human beings doing on the mines that the humanoid robots could do?
There are some tasks like trade-based tasks, diesel mechanics, fitters, people supervising equipment and all that sort of stuff, checking for safety issues and inspecting stuff. So you would imagine that over time you could use some form of humanoid robot to do some of that work. I think that's completely possible. And you just think of there's the FIFO system places a lot of strain on a lot of different things. So it would seem to me to be a pretty obvious solution, but the mining companies aren't talking about that. I mean, the other thing with AI, Alan, overnight, I've been noticing this, that there's a few companies starting to talk about the cost of AI and how expensive it's becoming. Now, there's a few companies that are really binging on AI and using it in lots of different ways. But there's overnight, the chief operating officer of Uber was out talking about how he's starting to get worried about how much they're spending on tokens and are they seeing the resultant productivity improvement. And this is this is noticeable that tech, AI is supposed to cut tech costs, but we had the ASX come out yesterday, the market operator, and say that their cost growth next year and the year after is going to be much higher because of tech inflation. We've had CBA point to tech inflation in cloud computing and other things. In the US, we've had a lot of companies saying, geez, there's a lot of the token cost and then what we're spending on cloud is really going up. So, I mean, maybe this is a temporary sort of bump in the road and eventually these costs do come down. But it's an interesting sort of moment.
I'm not sure it is temporary because when the companies that I'm talking to, what they're saying is that although the unit costs of intelligence are down, so the the costs of a particular task are lower if you use AI than human beings. The trouble is they're doing because the tasks are so cheap, they're doing it more often. So if you can get a marketing plan once a day instead of once every 3 months, they're doing it.
Yeah,
right.
Yeah.
They're just doing these things far too often because they can, and so that seems to be the problem. And so it's going to take a lot of discipline for companies to kind of wind back this stuff.
Yep.
And because, I mean, there's no doubt that if you can call it this, the unit cost of intelligence, however you might measure it, are definitely lower. It's just the amount you use it is the problem. I mean, I'm certainly spending more on this stuff. Well, I mean, I'm having to pay for a subscription to, one of these AI things, which is not that much. I think it's, $20 a month. But I was previously paying nothing for my Google searches.
Yeah. And, if you're someone who's, we all read these stories about people who've automated their life with AI in some way by using, hooking up. It could be various stuff, the household finances or their calendar or whatever it is, their email system, and getting AI to help them sort it or manage it. You do hear of people hitting the limits that the AI model companies like Anthropic and OpenAI set on these set for usage, and people are being throttled like they used to be in the old days of the internet.
Yeah, I know, and what these AIs are saying to you, and what my AI is saying to me is, if you want to remove the limits, it'll cost you $200 a month.
Yeah.
So please upgrade.
Yeah,
upgrade to the max program, $200 a month, please.
Yeah.
I mean, that's serious money.
Yeah, absolutely. And a bit like the Uber boss, you have to start figuring out, is it worth it? Am I actually getting something out of this, or am I just is it as you say, just better arranged Google searches?
Yes.
And Alan, I'm sure everyone's had a chance to interact with AI. Now, a ChatGPT or a Claude or a Gemini. It's very clever in the way it keeps asking you questions. Do you need more information? Is there something I can chase down?
I know.
Even the cynical journalist in me, Alan, wonders if it doesn't, because it often gives you an answer that isn't a complete answer, and you have to prompt it to say, what about this?
Yeah, I'm sure. Yeah.
The cynical journalist wonders if that's all part of the ploy to keep you using tokens and, keep you engaged.
Yes. Okay, all right. We've got a lot of questions. In fact, we've got 20 pages of questions this week. We just cannot possibly answer them all, everyone. Sorry, but we've chosen, as many as we think we can answer. Before we get to questions, here's a quick word from our sponsor.
If you're listening to the Money Café, you're probably the kind of person who doesn't want to be caught out by the next big shift. Whether it's AI, a policy change that hits your hip pocket, or a market move that catches most people off guard. Right now, Money Café listeners can get a special deal on Intelligent Investor Essentials. For just $297, you'll get Alan Kohler's Weekend Brief, the latest market and economic updates, and subscriber-only podcasts, including CEO interviews and Talking Finance, with in-depth interviews on business, the economy, and investing. And when you sign up, you'll also get a limited edition Money Café cap plus 3 months of Intelligent Investor Premium. That's $726 of value for just $297. Go to moneycafe.com.au to claim it before it ends. T's and C's apply.
And also, before we get to questions, usual warning that it's general advice only, not personal advice. So the first question is from Matthew. He says, is SpaceX's IPO a giant scam? Is Elon Musk coming for my money via ETFs? There is a YouTube video called the SpaceX IPO. It's worse than you think, going viral. This video explores several critical and controversial aspects of the upcoming SpaceX IPO that may warrant closer journalistic scrutiny. It argues that a quiet rule change known as the NASDAQ Fast Entry Rule will allow SpaceX to bypass certain traditional hurdles, effectively turning retail ETFs into exit liquidity for companies' insiders who will sell at peak valuation. Is this real, and what can we expect? What can retail investors do?
Retail investors, like institutional investors, including the managers of your super funds, dear listeners, face a really tough one here because it is right that the US market operators appear to be set to fast track the entry of SpaceX and probably OpenAI and Anthropic when they list into share market indices. And they'll do that by, as Matthew says, allowing them to enter despite the short period of, they'll allow them to enter faster than companies are normally allowed to enter these indices. And they'll sort of waive the rules. Usually to go in these ETFs, you have to be profitable. None of these companies are, and so they'll waive the rule around that. Sorry, to go in the indices, you need to be profitable, and none of these companies are. So, yes, your ETF, if you have an ETF that tracks the S&P 500 or the NASDAQ, your ETF will need to buy these companies. The one bit, I think there's 2 points to make about that, though. Yeah, okay, you could see retail investors as exit liquidity, but you got to remember a gentleman in the case of SpaceX, a gentleman called Elon Musk wants to retain a fair bit of control of this stock, and so how many insiders are actually selling is a good question. So, are you exit liquidity? Sort of, but how many insiders actually exit is a real question. And the other thing I'd say, Alan, is what's your alternative as a holder of an ETF that tracks the S&P 500? Do you may decide that you don't like the SpaceX listing and you think the whole company is a bit of a scam, but do you really want to stop tracking the index with it in there? I mean, tracking the index over the last 50 years has been a pretty good play. Is this the time to stop now because of one company entering it? I'm not so sure about that. I think that's not why you buy the index. You buy the index because of the diversification. That diversification doesn't stop just because SpaceX is suddenly in there.
No, that's right. Just while we're on SpaceX, if you look at the SpaceX prospectus, which you can easily find online, page 11, it's got a estimate of the total addressable market, which is $28.5 trillion US dollars, right? Of which 26.5 trillion is about AI.
Yeah, because
SpaceX is mainly now a AI company because they own Grok and the Elon Musk AI company called XAI. It's not really about space and satellites and so on.
No.
And so, and it's interesting. So, $28.5 trillion. There's never been any company in history that's kind of come up with a total addressable market of that much, or even anywhere close to that much. But I just finished talking to Jared Minak for the Intelligent Investor podcast, Talking Finance, and he was just saying, I've got a new startup that's got a total addressable market of so much more than that, and it's a water company, and the total because everyone in the world, every human being in the world needs water. So the total addressable market of water is much more than that.
Yeah, of course.
You know,
Where can we buy shares?
Oh, that's right. And the thing is that water is not a very good business because, you know, it's very competitive and it's regulated.
Yeah.
So, you know, is this going to – I mean, so look, you'd be crazy to get carried away with total addressable market of $28.5 trillion US.
Yeah, well, I mean, I think I wrote on the day that these total addressable market numbers are rubbery, but this one's like jelly on a paper plate. I've never seen something that's such a, you know, finger in the air.
I know.
Guesstimate. But anyway, I look forward to hearing Jared. His stuff is very hard to read for mere mortals, but because it's hard to get your hands on. But he's such a guru, so I'll look forward to that podcast, Alan.
Yes. Okay, next question.
Jay says, I'm a long-time listener and occasional question sender here. The recent closure of the Strait of Hormuz highlighted just how dependent we are on petroleum for far more than just fuel, fertilizer, plastics, and even everyday products like plumbing pipes. So if we're transitioning to renewable energy, why aren't we seeing comparable investment and discussion around replacing all those petroleum-derived products? And realistically, is it even possible to move away petroleum for most of its non-fuel uses? Great question, Jay.
Yes, well, and he's right. I mean, but people are working on it. Trying to come up with a battery-powered aeroplane. But you know, it's hard. It's it's a very long way off.
Yeah, and fertilizers and stuff. I actually fertilizers and plastics. I actually haven't heard of many people working on that. I must say, Alan. You know, petroleum-derived products are in everything. They're in our clothes. You know, polyester has got oil in it. So I actually haven't heard of many substitutes for those products. And the problem, Jay, is that the substitutes can tend to be very expensive when you can find them. A sustainable aviation fuel is a great example. It's a lot more expensive. Some of these things can, you know, hydrogen, which was seen as the great substitute for some of these things, it's bloody expensive to make, and that's really ruled it out as a substitute at the moment. So, yeah, I think it's a great point, Jay, and I think the answer is no. We don't really have, economic substitutes for most of those products, and that's why this Strait of Hormuz episodes reminded us of how reliant we are on fuel still.
And will be for a long time. I think that
exactly.
You know, the energy transition is real, but it's a transition from coal to, as we've just been talking about, to renewable energy and gas in the electricity market, and also from internal combustion engines to electric vehicles. But that's about it at this stage. I mean, there's much more to it than that.
Yeah.
James says, I became a devoted subscriber after you introduced me to Clean Tech, TEQ, now called Sunrise Energy Metals back in the day. It ended up being one of the most spectacular rallies in the ASX, gaining roughly 3,900% from its lows. Thank you.
There you go.
You're welcome, James.
You're welcome, James. We do not give personal advice or
we do
on
not.
This show.
Right. With that old world market win in mind, I want to ask you a massive piece of new world disruption. The HYPE token, HYPE token, has done something incredibly rare in crypto. It has completely broken its correlation link with Bitcoin, more than doubling in value while the broader market wobbled. HYPE is the native token of Hyperliquid, a decentralized exchange run by a tiny team of just 11 people. A recent watershed profile by Colossus revealed that this tiny team generated over $900 million in pure profit last year, operating 24/7 with zero venture capital backing. They've even started tokenizing traditional macro assets like gold and oil. My question, when an 11-person tech protocol can build global financial architecture that matches the profitability of major institutions with virtually zero overhead, what does this mean for legacy exchanges like the ASX? Are old world brokers and clearinghouses structurally cooked, or will regulatory moats protect them? Interesting question.
Yeah, I think the answer, James, is a little from column A and a little from column B. I think, tokenization and the use of the blockchain is the probably the best thing to come out of the Bitcoin world at present. It is really valuable for these sort of market operations that James has described. And in America, at least, tokenization is becoming more common. It's got better regulatory backing, ironically, thanks to Trump. And so I think we will see more tokenized products, more tokenized financial infrastructure in place around the world. And over time, the ASX and competitors to the ASX will use tokenization to great effect to lower costs and improve speed and, improve accuracy. But yes, the regulatory piece is the moat. How ready will regulators be to trust that technology and trust those operators? The thing about the ASX is that it's not an 11-person company. It's a big listed company that with, lots of directors and lots of staff and lots of capital that, when ASIC finds, as they have, that the ASX hasn't been operating in a manner that, befits them, that ASIC actually has someone it can go and beat up. That's important. Now, can you bring the same regulatory hammer down on 11 people working out of a garage somewhere? Probably not. And so I think that is going to be a moat for a while, but not forever. Not forever. There are definitely tokenized operations or tokenized operators who have a bit of heft behind them, can have a bit of capital behind them, and can, in Australia, I think ASIC would love to see a bit more competition to the ASX, for example. And so perhaps they are a bit more willing to back the new operators, if that makes sense.
Yeah, it's also worth saying that I think that the financial disruption brought by the blockchain, which was basically the fundamental thing that Bitcoin brought, apart from speculation, has taken a bit of a back seat lately with all the sort of hype on AI and also obviously the war in Iran and everything. So no one's really talking about that, and Bitcoin's going nowhere. But I think that disruption's still going on. Blockchain is there and people are working on it, and it is kind of there. And also central banks are working on central bank currencies, digital currencies that are also based on the blockchain that they're running themselves. And, I think that eventually that'll happen. And so you're probably going to eventually end up with some sort of form of programmable money because central banks want to do that. So I think the disruption's happening. To what extent it's kind of, little teams like Hyperliquid or, more official, I don't know, but it's definitely going on.
Yeah. Kane says, so the new budget includes Treasury estimates that there'll be less houses and therefore higher rents as a result of the changes to negative gearing and capital gains tax, but I can't figure out why. Surely there is still the same number of investors available. Won't they spend their money on new houses instead to make use of the exemption, supercharging the new house market? Won't they also hang on to their current investment houses to also make use of that exemption? Where's the gap come from?
Interesting. I mean, I do think that the Treasury was surprisingly pessimistic in its estimate of the impact of the CGT and negative gearing changes on the building of houses, where they predicted it would result in 35,000 fewer houses, only offset by 65 more houses from the infrastructure fund of 2.1 billion that they're creating. So that the net change from the budget, is a plus 30,000 houses. But the negative gearing is supposed to be focused, or will be focused only on, or available only on new housing, which is designed to result in more new housing. I don't know why they're being a bit pessimistic about it, but I guess that's the CGT change.
Yeah, exactly. The capital gains, there's no exemption for new housing, and so I think the view is that there will be a bit of flow on from that. People just, people won't want to invest in even in new houses, despite that negative gearing exemption, they'll be put off by the CGT change. I mean, we're talking relatively small numbers according to Treasury's modelling, but Alan, frankly, I mean, the Treasury modelling for housing supply and for rents is over 10 years. It's a bit like the SpaceX total addressable market. I mean, God knows how they did the modelling. Let's wait and see.
Modelling's kind of, forget about it. It's really meaningless, isn't it?
Yeah, I think that's right. But look, I mean, one thing I will say, Kane, is I think there is a level of surprise out there amongst property people, certainly economists and analysts. There's a bit of surprise about the size of the hit to sentiment in the property market, which we're seeing come through early in, soft data, so auction clearance rates and sort of surveys. But this does seem to have really whacked the sentiment of property investors, which, I've got to say, that's what it was supposed to do. So
that's right. Exactly.
I guess in a way it's effective, but how that translates to prices, I think there's a lot of, I think people are really having to wait and see there. The hit to prices might be bigger than we think, particularly if we get a couple more rate rises.
Yes. And do you think that, just while we're on this, do you think that they'll cave in and confine the CG, capital gains tax change to property only and exempt startups and businesses?
Yes. I mean, I think there's going to be some rollback. I'm not entirely sure what that rollback looks. Is it a different rate for businesses? What do they do about shares? I don't know. That they've walked into a bit of a mess here, haven't they? And
I know even Matt Common's calling for putting it on property only.
I mean, I'm sure you'd know better, Alan, but I can't think of a budget in the last decade at least that is still white hot 3 weeks after the event.
Yeah,
it's fascinating.
It is white hot, exactly.
It is white hot. It is all people want to talk about.
Yeah,
it's incredible. So Jordan says might still be a touch early with 5 weeks left in the financial year, but I wanted to revisit James's prediction from the end of 2025 that the ASX would be up 10% by June 2026 and then finish the year relatively flat. Given where the market now sits, do you still hold that view? Have any major events or economic shifts this year changed your outlook either way?
There'll have to be a decent rally in June, won't there, James?
Yes, Jordan. Geez, our listeners are good, aren't they? They're like elephants. They never forget. So the ASX is actually down year to date, 0.8%. So my prediction is looking absolutely cooked. In my defence, Jordan, such as it is, I don't think anyone foresaw the biggest energy shock in the history of the world, which has added to Australia's pretty ugly inflationary environment. And so, I mean, I think over the course, it'll be remarkable if the ASX, it won't be remarkable. It'll be impressive if the ASX can finish in the green for the year. Maybe it finishes up 1 or 2% as the Iran situation sort of sorts itself out. But we've still got this. The RBA's still got this really big problem with inflation. It had a problem before the war started, and I think the problem was bigger than I thought it was. And so we start the year with these 3 consecutive rate rises. We're probably going to get another. If we get a fourth, then the pressure on the domestic economy is going to be huge. I mean, I sort of keep writing about this. The problem the RBA's got is that rates don't work like they used to. And part of the reason for that is that we're also rich. Household wealth in Australia has gone up 3 trillion in the last 2 years, and through house prices and investment returns, and that challenge continues to bite. So, it's hard to make a prediction. I would say the ASX finishes the year flat and sort of just trades in a fairly narrow band because of the domestic. The domestic outlook's pretty tough.
Jordan had a PS, by the way. Any chance the Money Café hat can be bought separately without an InvestSmart subscription? I would love to buy one. Why don't you just email support@investsmart.com.au. That's what Greg says. So, email that, support@investsmart.com.au, and someone will give you a hat, I think. That'll be good.
Any hats for participants?
Haven't you got one?
No.
Oh, James, we've got to get you one or two. You can give one to your wife. She'll love to wear it. Yeah. Nick says, Alan has pointed out the political flaws with indexing income tax rates to inflation, tax cuts by stealth. But what about the economic case against them? It seems to me that the coalition's policy would be pro-cyclical, where periods of high inflation would have bigger tax cuts, returning greater amounts to people, fueling demand and inflation, while the opposite will be true when inflation is low. This will undo the counter-cyclical impact of bracket creep. That's true, isn't it? Yeah.
Yeah, I think that's right. It's a tough one. I mean, Nick's right that there is a case against them, but do I sense that Nick's sort of trying to say bracket creep's a good idea?
Well, I think he might be. I do think. I mean, I'm not sure I said this, but I think that if you're going to get rid of bracket creep with indexation of tax scales, fair enough. But you've got to find some other way of increasing or getting more, having a growth tax. And so you simply have to, in my view, offset it by increasing GST to something close to the OECD average of 20%, or have a wealth tax of some sort, which a lot of companies do. I mean, countries do. So because, I just don't think it's even Angus Taylor, I don't think is capable of cutting spending to the extent necessary to deal with the end of bracket creep.
Yeah.
He can talk all he likes about it, but I think that if you end bracket creep, you're going to end up with bigger deficits because there's no way they're going to be able to cut spending to the extent they think they can.
Yeah. I'm going to finish with one, Alan, from Peter, and he notes a recent line in a report from Brambles, which is the big pallet company, the pallets that sort of a big part of the plumbing of the logistics world. We send all our stuff around the world on pallets. And Brambles said on May 18, it has become clear that the increasing plant automation by customers is leading to a requirement for consistently higher quality pallets compatible with these automated handling systems. And Peter asks, is this the first sign of an impact to business from AI and robotic automation?
Interesting.
Great spot, Peter. Yeah.
Did you pick that up when that came out?
No, I did not.
So, is Bramble saying that that's going to be good for them? I suppose they are.
Well, it's in a way, because if you remember, on the Brambles on that day had a big, they did some big, announced a big sort of expensive upgrade to one of their plants. I think what the problem is, it could be good for Brambles over time, but it now has to produce those high quality pallets, where obviously previously it could get away with lower quality pallets. So I think there's a big expense jump first that is the problem.
Well, I'm sure they can sell them for more though too, because the customers' costs are going to come down by not employing human beings in their warehouses.
Yes, that's true. But there's like everything with AI, there's a sort of gap in between, isn't there, that has to be dealt with.
It's a double-edged sword there.
Exactly.
Well, very good. So we couldn't even get through the questions that we picked out, let alone the 20 pages of questions. So anyway, good to talk to you again, James. Have a good summit about mining and in Perth, and we'll see you in a couple of weeks.
Yeah, thanks, Alan. It should be good. I love being over here and talking to the mining industry. It's great.
Thanks everyone for listening to today's episode. I'll be back next week with Stephen Main. Send in your question to the Money Café at intelligentinvestor.com.au, and we'll try to answer it. But we're getting so many, it's getting hard to. But we'd love to
keep them coming though.
Keep them coming, and we'll certainly do our best. Until then, I'm Alan Kohler, editor at large of Intelligent Investor and finance presenter and columnist and podcaster for the ABC.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.
Thanks for listening to the Money Café. If you want a little extra to take away with your latte, try Intelligent Investor Essentials. Go to moneycafe.com.au. For just $297, you'll get my weekend briefing at 7 a.m. on Saturday morning, Talking Finance podcast, CEO interviews, plus a Money Café cap, splendid thing it is, and 3 months of premium. That's Intelligent Investor Premium. It's a great deal. It's valued at $727 for just $297. Get in quick at moneycafe.com.au and T's and C's apply.